Today's topic is present value and internal rate of return. So at the end of this short webinar, what I'll aim to do is help you understand the relationship between present value or net present value and the internal rate of return, known as the IRR, and how these two metrics can help in making buy, sell, and hold decisions for a real estate asset. So let's go straight into it. So let's think about our decision framework. So to do this, we'll consider a property. So let's say we have a property with an annual rent there of £100. And the question is, should we buy this property? Should we sell this property or hold this property, depending on whether it's a potential acquisition or whether it's in the portfolio at the moment? So we need to try and set up this decision-making framework. So one of the key inputs is going to be the target return. So I'm going to assume here a target return 7%. Now that's a very big assumption, and we'll be exploring the components of the target return in detail on the course on the 20th of March. Very briefly, a target return is made up of a risk-free rate plus a risk premium. So the interesting parts are, firstly, roughly what sort of risk-free rate should you be using, what sort of duration of bond, and then secondly, how do you work out what that risk premium is, what it's for? So transparency, liquidity, and volatility. So we'll be exploring that on the 20th. Now, we're going to assume some growth in this cash flow. So we're going to assume, for simplicity, that we're going to get growth of 2% per annum. So again, this is a very key assumption, something else we'll be discussing on the 20th. What assumption is reasonable? What about nominal versus real growth rates, etc. But that sort of sets our scene. So we want to decide whether to buy, hold, or sell. So the first thing we're going to do, so we've got two approaches. One is to calculate the NPV and the other is to calculate an IRR. So the first one we'll do is to calculate the PV of this property. And we're going to do that by what we call capitalizing the rent. So the rate we're going to use is known as the capitalization rate or the cap rate. So the important thing is, well, what is the capitalization rate and how is it calculated? Now, normally what people will start talking about is you go to comparables. So you'll look at comparable properties and work out what the rent is divided by the sale price. We're going to lay this framework out in a slightly different way. So we're going to say, look, the way we're going to work out this cap rate is we're actually going to look at our target return and our growth rate, and we're going to use that to calculate the cap rate. And the reason why we want to do that is so we can really get underneath the skin of how a PV calculation or net PV calculation, how that relates to our internal rate of return. So we're going to capitalize, which is a very simple idea. So we can just, because it's a percentage, we're not multiplying, we divide. So we're going to calculate our present value, our PV, and we're going to divide our rent by our cap rate. So our cap rate there is our target return minus growth, which is 7% minus 2%, which is 5%. Hopefully several of you listening in will recognize that as the formula from the Gordon growth model. Many of you might be thinking, well, why has he used 102? Surely you should be using 100. Well, this is because to use these formula, we're going to use these formulas to get them to work. They work when the rent is both received and also set in arrears. So because this rent is going to be received in arrears, but also set in arrears, then we're going to have to apply 1 year's worth of growth. So the PV is actually 102 divided by 5%, which equals 2040. And it'll become clear in the next couple of slides why I've done that. Of course, in practice, rent payment frequency will be different. It'll be monthly, it'll be quarterly, and the rent, well, in the UK, it's usually received in advance. And they will impact on the formula. But for now, we're going to stick to this very simple formula. So the decision framework becomes very simple. So what we do is we deduct the purchase price, or the current value if it's in the portfolio, from the PV. So this now becomes the net present value, or the NPV. So that formula becomes the PV minus the purchase price, or the current valuation. And our decision rule becomes very simple. So we buy or we hold this property if the NPV is positive. So if the purchase price is below 2040, we would buy. If it's above 2040, we wouldn't buy. If it's in the portfolio, we would sell. So that's our first decision rule. But in real estate, what tends to happen is that we use an IRR calculation. So we're going to approach exactly the same calculation, but this time we're going to reformulate it as a return calculation, and specifically an internal rate of return. So what does this involve? So basically we need to work out the PV of the property at year 0, which we've just done. So that's our 2040. But we also need to calculate the exit value as well. So to calculate the exit value, we basically apply the growth rate, which is 2% per annum, to our £100. So you can see that compounding up here. So 102, 104, 106, 108, 110. So in this webinar, we're trying to understand the sort of foundations. We've basically got an annual review frequency here. So when it comes to market practice, you might have 5-year reviews or 3-year reviews. So we would adjust the formula appropriately. But for now, we're going to have this very simple compound increase in the rent that we're receiving. So we can calculate the exit valuation in the same way as we calculated our entry valuation. So we don't use this 110. We actually calculate it using the year 6 cash flow. So it's 113 divided by 5%, which equals just over £2,250. So what the internal rate of return calculation is going to do is it's going to solve for my rate. So let's lay this out. So there's our 2040 at the beginning. Here's our cash flows received annually in arrears. Here's our exit value plus the year 5 cash flow. And by the magic of the way we've laid this out, that equals our target rate return. Now, I thought it might be useful just to put that down in a spreadsheet so that we can manipulate the time periods a little bit. So here's our growth rate there at 2%, our target return at 7%, so our cap rate coming in at 5%. Here's our rent increasing year on year, compounded at 2%. So we can work out our PV at any point in time simply by dividing the rent by the cap rate. So you can see I've done that in year 0, and I've done that in year 5, as per the slides. I can lay out my IRR, and the IRR comes in at 7%. But what you can also see is if I calculate the PV basically over any time period, and I calculate my IRR over any time period, so 5-year IRR all the way up to a 10-year IRR, we will always get 7%. So we've always got that relationship going through. So once we've established this framework, we can now do various things. So we can change the growth assumptions. And this is why I think people in the industry tend to use IRRs, because quite often you'll have a forecast for rental growth, but that forecast will typically only extend for a few years. And after that, you'll probably revert to a long-term average. So by having an IRR, it enables us to manipulate those cash flows during the IRR time period. We can also adjust our exit assumptions. Now, why would we adjust our exit assumptions? Well, there's two key impacts. They are the financial and the physical characteristics of the property. So the first thing we need to consider is, has our property depreciated? Should we be changing our target return or changing our long-term growth assumption? And also, have the financial conditions changed? So in our example, we don't have a lease, but what if we've got a lease? So the lease may have started at 10 years unexpired. At the end of 5 years, it's going to be 5 years unexpired. So how would that change our exit assumptions? And then the other reason why in real estate we tend to use the IRR is because we can then basically test any active management that we're going to do on the property, what the associated costs are, maybe vacancy periods, etc. And we can test those on our IRR. That's what we've done in this session. We've compared the net present value with the IRR in property investment. And we can delve into this more detail on the course. So we can modify all of those formulas. So we can modify those formulas for the rent payment basis. So whether it's in advance or in arrears. So what does that do to my cap rate? We can change the review frequencies. So rather than an annual review frequency, what happens if we move to a 5-year review frequency? What does that do to our cap rate? What about costs? What about letting periods? What about vacancies? So when it comes to costs, are we going to be capitalizing a net rent or a gross rent? What are we going to do with our vacancy periods? Now, this would typically be either included as an explicit assumption, or it will be assumed as an implicit assumption. So we'll be exploring, if we're going to do this explicitly, then how do we adjust the cash flow? If we're going to do it implicitly, then how do we adjust our cap rate? And then, of course, the big one, not the big one, actually, a bit of the sort of a topical aside about IRRs. The way we've laid out our framework here, the IRR always equaled our investors' target rate of return. However, there are ways in which the IRR actually will basically be assuming that you're always reinvesting. So there are calculations of IRRs which actually will generate levels of return which you're unlikely to be able to replicate in future years. So this is when IRR can actually be misleading, and that's why we also would typically calculate a net present value as a check against our IRR.